Hey, everybody, good morning and welcome to 2025. My name is Hunter Satterfield, the Chief Investment Officer of Kane Waters, as well as one of the partners here. As always, today I am joined by our friend from Tectonic Advisors, Brad Sanders, who is the Managing Director over there, and then my fellow partner, Brian Bortz, who is the head of the CWA Investment Committee. Guys, always great to have you. Everybody, this is your January market update. For the month of January, the S&P 500 was up 2.8%, with global stocks up about 3.3%. Good month overall. We'll be going to Brad to talk about that. But domestically, we're up 0.5%, with global bonds up 0.6%. Obviously, Brad, I want to start with you related to it was obviously a good month, but man, intra-month, we've seen just a ton of volatility, the market moving and swinging quite wildly. And there's a whole bunch of reasons for that. Trump and tariffs and the sort of unknown nature of his policies and whatnot. You want to talk a little bit about what your team is seeing related to volatility, and whether or not you feel like this might continue?
Yeah, I mean, you had a spike in the VIX this month, which is the volatility index. It's based off the options on the CBOE. That's kind of how it's measured. And yeah, I think this is just going to be kind of the nature of things, at least for the next 6 months. A lot of unknowns based on tariff policy. I mean, just this, the last over the weekend, you had the 25% or whatever the tariffs were against Canada and Mexico, 25%, and then those were quickly rescinded. And then you had a 10% on China, which was kind of out of left field. And then they retaliated last night and said they're going to do 15 against us. So that one's up in the air. So you're just going to see a lot of market swings based on that, because that's very fluid and it can go away tomorrow, or it could last for months or years. I don't know. In the meantime, what happened in January kind of benefited our portfolios. You had the DeepSeek announcement out of China, which kind of threw a wrench into the AI spokes. You had last Monday, Nvidia's down 17% in a day, bounces 10% the next day, gives it all back. The broader markets outperform the S&P. Our portfolios outperform the broader markets. And so I think we're positioned correctly to weather this. I think you're going to start to see money get invested more broadly, particularly as tariffs start to affect the price of things and domestic companies, start to do better based on, pricing and margins and all that kind of stuff. It's just probably not going to be as smooth of a ride as we've been used to, certainly the last 2 years. And that's okay. Volatility is kind of our friend. We're fundamental investors at heart. And when, things get cheaper based on market panic or market wild reactions, we can just buy more at better prices, and over the long term we'll make more money. So it's a better environment for certainly active investment, but it's just going to be probably one of those, a couple quarters here where, day to day, you might be having a, kind of a tumultuous relationship with the stock market.
Yeah, no, it's great. And Brian, obviously, we've talked at length ahead of this recording just about the volatility we expected in 2025, and that certainly is borne out for the first 31 days here. Brad, I think, talked a little bit about diversification, which is super important right now from an investment standpoint. What are the types of things are we wanting, clients to really understand and think through over the next 6, 9, 12 months as we sort of deal with this level of volatility in our portfolios?
Yeah, thanks, Hunter. You're exactly right. Volatility is going to be, kind of an ongoing theme for the first half of this year. I think that the markets and investors were a little bit euphoric whenever the election results came out, because the concept was that the new administration would be good for the stock market. I do think that the economic policies there are going to push the boundaries, make the Fed uncomfortable a little bit. You saw that the Fed paused their interest rates declining, so they held interest rates this month. I think you're going to see inflation try to hold on a little bit closer to 3% than their target at 2%. So I'm just telling my clients, look, the benchmark is one thing, and you always need to have a benchmark, and usually the benchmark is an index like the S&P, but the S&P doesn't look like the market right now. And as Brad just mentioned, you have the largest company, that the heaviest weighted company in the S&P, up 17 or down 17% one day, up 10% the next. down, a double digit the next day after that. You're going to have these wild swings in indexes, and that doesn't mean your portfolio is going to have those wild swings. Our goal is to set what you need for your plan to work, and then achieve that with the least amount of volatility possible. And so I'm telling my clients it's a long-term play. Yes, we pay attention to what's going on in the markets, but we're not, tied to an index. We have really good investment managers that reduce volatility. And I'm really excited about how we're positioned. And I want to echo what Brad said. I think we're in a really good place right now.
Yeah, that's great. Yeah, appreciate it, guys. And folks, it's going to be an interesting year to say the least. It's almost seemingly as we record things, it's almost out of date just with how quickly things are and how volatile they are. So we'll be back in front of you certainly at the end of February. You can also grab Accumulating Wealth podcast for more up-to-date weekly reports kind of in on how things are going. And of course, if something big happens, we'll be in front of you with that almost immediately in order to get you our thoughts as well. So have a wonderful February, and we will catch you at the end of the month. Thank you.